Happy New Year. I am Jeff Bermet, and along with Nick Davis, we are the co-managers of the Libero Cautious, Dynamic, and Solution Funds. 2025 turned out to be an excellent year for all of our funds, particularly Dynamic and Solutions. I think the best performance those funds have ever had in a calendar year. We had several positive things working for us. Growth was generally strong in the US and in Europe. China was trying to stimulate their economy as well. Japan wound up electing a new leader that added further stimulus also. Energy prices stayed low. Oil just continually dropped all year. We think those factors are going to continue into this year, into 2026. The themes that really helped us last year was the big change in Europe and European defense spending because of how the US was backing away from supporting Ukraine, and it really forced Europe to sort of stand on their own two legs and raise their commitments to defense spending. And Germany also vowed to expand their budget deficit materially, and this has really required a change in German law to allow them to run larger fiscal deficits. And all of that contributed to very strong returns in the defense sector. Another powerful theme for us has been just the growing demand for electric power. This demand for greater electric power has really strained electric grids around the world. Most of those are aged, need to be upgraded, expanded, and so that requires a lot of raw materials, copper in particular. We have benefited in the portfolio by holding some mining firms. Gold has also done exceptionally well this year, and we have had gold holdings in a couple of the funds. Almost every developed country in the world is running a fiscal deficit. And this is at a time when growth is generally positive in the world. So it's very incongruous to have that circumstance. Typically, large deficits are associated with recessions when there's a fall in tax revenue. But we now have the case where large deficits are associated with growth because governments are spending more than they take in. And there is some concern by investors that long-term government yields, you're going to see your returns eroded by inflation. And I think gold stands out as an alternative to hold in your portfolio. But along with this rise in longer-term yields relative to the front ends, that's been very good for the financial sector, for banks in particular, and we have had significant exposure to banks. Initially, it was US banks, and then we switched more to European banks, especially after Europe decided to change their fiscal outlook and concentrate on more domestic infrastructure spending and more defense spending. Now inflation, at least in the US, the UK, and the Euroland, has come back down to close to target. In Europe, it is at the 2% target. In the UK and the US, it's still closer to 3 than to 2. There seems to be an expectation on the part of the Fed and the Bank of England that it's going to get back down to target. And so you may get a little bit more in the way of rate cuts by those two central banks, but the Bank of Japan is actively raising rates as their inflation is well above 2. We would expect more rate hikes there. So we think the rate cutting cycle is nearly over, and this does pose risks to the longer end of the yield curves. We still are wary of holding much in the way of longer-term government debt. We're happy to own front-end and intermediate credit. We're happy to own investment-grade bonds in the 0 to 7 or 8 year sector of the yield curve, but we are uncomfortable going out much beyond 10 years in duration because of these worries about inflation and fiscal deficits. We remain optimistic on growth for 2026, and that should lead to continued growth in earnings, and we think the themes that served us well in 2025 will continue to serve us in 2026. That being said, we do have a feature now where the US and the Trump administration are increasingly adding volatility to the markets. I think it does contribute to the increase in defense spending that we have been seeing around the world, not just in Europe, but even in the US and in Japan and in Korea. And I think that's just going to be a fact of life. A little bit higher volatility, it may mean things are bumpier than we have been used to. But now I'll pass it over to Nick to talk about some individual highlights in our portfolios.
So Jeff has talked about a number of things that we see going forward in the year and about some of the areas that have performed well for us over the past year and how they're going to perform going forward. One of the key areas we've talked about going over the last year ad infinitum has really been defence, both in the US and in Europe. And those stocks we've held there, such as Rheinmetall, Leonardo, have done fantastically well, both providing over 100% returns over the past year. We still believe these stocks will continue to do well, and we still have exposure to the sector and increased it, as you remember, earlier this year with adding to the US with an investment in Lockheed Martin and also a long-term holding of RTX Raytheon Corp. Other areas Jeff talked about were the energy sector and predominantly about the impact from AI and the demand for energy that's going forward around the world globally. We're looking at this through utilities, through energy, both through oil companies, and again through commodities where we need the input to actually build the materials we need for this. So the mining positions we've held have done fantastically well of late. The gold we've held in the portfolios for solutions and cautious have had a very stunning year, over 50% returns in sterling terms. The other area we look at has been financial stocks. And again, the whole dynamic of interest rates has been key to us over the past year in terms of managing all three portfolios and the focus of where we've had the currency exposure in the portfolios, and again, where we position the interest rate exposure for fixed interest in terms of cautious and solutions. As Jeff mentioned, we've stayed at the very shorter end of the market to reduce volatility and still achieve steady returns in the portfolio. Currency has driven our rotation away from US banks and into the European banks. One, we see the stronger economy, but two, again, the yield curve has heightened in the same direction. In fact, returning to what we refer to in the olden days as a normalized yield curve, with yields higher at the longer end than the shorter end. We moved into Japan with a holding in Nishi Nippon to give us a Japanese bank at the end of the year. We haven't completely avoided the US because you can't. I've mentioned defense already, and that's a key area, that's one of the key themes, and the US is going to be a key component of that. Despite Europe looking to buy its own assets, companies like Lockheed Martin, with the provision of the F-35 fighter, will be a key expenditure for European companies and for missiles which are being required for defence of Ukraine and for potentially future Europe are provided by Raytheon. We have also had exposure to technology stocks, which are the big names which we've reviewed over the year. We sold Microsoft, as you remember, but we still hold Alphabet and we still hold Amazon, which both have done particularly well. One of the areas we've talked about in terms of AI has been about chips and how we have avoided NVIDIA and our concerns about that as a key player, as the key chip provider. And our concerns were really centered around the fact that we thought someone would supersede them or other chips would become available at a cheaper and more available price. And we've seen that happen over this year with the Alphabet's announcement of its new chip. We've seen Samsung, which has been a very quiet stock behind the background and performed incredibly well as its chips have taken up the demand that's been created by the scarcity of chips from NVIDIA. Jeff mentioned utilities in a broader sense, and again, this is how we have looked to play AI, the energy debate, again through things like SSE, a British utility company, which we've actually had quite stunning returns for a company that is generally perceived to be a very boring investment. We added European short-dated bonds in cautious and solutions, and also we went looking in Australia. It's this fact that we're looking globally around the world for solutions for you, where domestic trends are driving us there because the trends are in place, the rationale and the thesis behind the investment decisions are there, and we're keeping on looking for added value to the portfolios. We've had some great successes over this year. We look forward to having more in the new year. And again, we'd just like to thank you all for your support and backing us in terms of the investment into the funds.